Welcome to Accounting 201, and today we're going to do a problem discussing inventory and how calculations for inventory can change based on needs of the financial statements and not necessarily the flow of the goods as they pass through our inventory system. So I'm going to read you the problem here today and we'll get started. Crystal Apple Sales Company began year 2 with cash of $2,000, inventory of $3,600, 200 crystal apples that cost $18 each, 2,500 of common stock, and 3,100 of retained earnings. The following events happened during year 2. So we see that Crystal Apple purchased additional inventory during the year a couple times. They sold some apples. They paid cash for their inventory purchases, and they paid cash for operating expenses. So we're going to record these financials, these events in the financial statement model using the FIFO, LIFO weighted average, and then we're also going to prepare the income statement, balance sheet, and statement of cash flows under these 3 assumptions. So the one thing that I want to point out to you and make sure that we understand is that those LIFO, FIFO weighted average, first off, a company would only pick one. Now, they could pick one for different product lines, but for the most part, they pick one for their company as a whole. Additionally, it's hard for analysts to compare companies that, although might be in the same industry and might be the same size, when we're talking about sales-wise, they're the same size. But if they use different inventory cost flow assumptions, then we'll see that you actually would have to do an adjustment called a LIFO adjustment if they're using LIFO and the other company's using FIFO in order to compare the companies for analyst purposes using different indicators such as liquidity and things like that. All right, so here, this is what I call the cost of goods available for sale chart here. That's this chart here in the middle, this cost of goods available for sale. We have a beginning balance and then the purchases that were both discussed in those events that I just read to you at their cost per unit, and then multiplied out, we have the total cost. So during this particular year, we had 2,200 units that were available for sale. We had a beginning balance and then a purchase, and then we had the total cost. So for those 2,200 units, we had a total cost of $48,400. So using the FIFO, which is the first in, first out method, we are going to determine what the total cost on the income statement will be, which is the cost of goods sold, and then what the total cost on the balance sheet would be, which would be what's left in ending inventory. So if you have this total available for sales, the total available, and you subtract out the number of units sold, or units sold, then you're going to have what's left, or ending inventory. Okay, so if you add the units sold plus the ending inventory, whether it's a dollar amount or the number of units, then you're going to get this available for sale. So I'm always trying to calculate back to this total available here. I'm always trying to account for those totals. So part of that, this total available of 48,400, part of it will go to units sold, which would be on the income statement. And part of it would end up in ending inventory, which would be the balance sheet. So first in, first out, we are going to start, let's first off figure out how many they sold, right? So they purchased inventory. That's what helped us, this particular one, event number 1 helped us put together that cost of goods available chart that we were just going through. And it said that we sold 2,040 apples for $40 each. 2,040 apples for $40 each. All right, so let's start here with this computation. So I'm going to start first in, first out. First meaning I'm going to start with the beginning balance. So first in, we had 200 units. The cost per unit is $1,800 per unit. So my total cost is $3,600. Okay, so I'm just going to take all of those 200 units. Now I'm trying to get to the 2,040 units. Okay, I'm trying to get to that 2,040 units. So I'm only at 200. Well, if I add in 800 units, I'm still at 1,000. I'm not there yet. Those 800 units cost me $20 per unit. I'm pulling from the chart here. So my total cost is 16,000. Okay. Not there yet. I need an additional 1,040 units. So 1,040 units. Out of this 1,200, 1,040 units would go to cost of goods sold. So this is cost of goods sold or units sold, 20,040 times, those were at $24 per unit. The total cost for that particular layer is $24,960. Okay. If you add those three numbers together, you're going to see that cost of goods sold under this method would be $44,560. So that's the amount that would show up on the income statement as cost of goods sold. That means that the remainder, because remember total available for sale, I'm going to erase this here so I can use this space. Total available for sale, the 48,400, that's the available, less 44,560, that's what is sold. That means that the remainder is an ending inventory. Okay, so let me just calculator here. That means that you will have an ending inventory of $3,840. So that's the amount that will end up, and you see that right here. That's the amount that would end up on your balance sheet. Additionally, you can do this in units too. The total available for sale in units was 2,200 units. You sold 2,040 units. That means in your ending inventory, you should have 160 units available. Okay. So that's the cost flow assumption method using FIFO. So 1A, we saw that with 1A, the transaction that you purchase inventory during the year. So that's these inventory purchases that we see up here. So the inventory purchase, there's the first inventory, maybe. Okay, thank you. That's the first inventory purchase and the second inventory purchase. So the first inventory purchase would increase our inventory by 16,000, and then it would also increase our accounts payable by 16,000. That would not affect our income statement or our cash flows because we've not exactly paid the cash yet. Additionally, we purchased inventory for 28,000. That's the second purchase. We put that on account for 28,000. Again, as same before, there's no income statement and there's no cash flow effect here. Okay. 2A says that the company sold apples. They sold 2,400 apples for cash at a selling price of $40 a piece. Now there's two sides to this. The amount of cash that we brought in, let's go ahead and record the amount of cash that we brought in. That would be 2,040 times $40. So we brought in $81,600 in cash in sales. Okay, $81,600 in cash in sales. So I'm going to increase my retained earnings by $81,600, and that's because there was an increase in revenue. So I'm going to put that over here on the income statement. I'm also going to show that there's an $81,600 operating activity. But every time we record a sale, we have to record that portion of the cost of goods sold. And so the cost of goods sold for that period for selling those 2,040 apples, the cost of goods sold is what we calculated right here using this particular method. Now, I'm not going to go through this horizontal analysis for each and every one, but this is right here on 2B. This calculation, every time I do it, this is where that calculation is going to change those financial statements. So up until now, everything would be the same no matter which cost flow assumption you use. But this is where it particular changes. So we're going to decrease our inventory by $44,560. And this is also cost of goods sold, which is an income statement expense of $44,560. So you're going to see a decrease here of $44,560. That's a decrease. And that's not a cash item, so the cash would not be affected. All right. 3, the company paid $44,800 cash on accounts payable for inventory purchases. So you're going to see cash decrease. So $44,800 cash decrease. You're going to see your liabilities decrease. That does not affect the income statement. I don't see anything there, but you will see a decrease in cash flow, $44,800. And that's an operating activity. All right, and the final one is they paid $26,000 cash for operating activities. So you're going to see a decrease in cash of $26,000. You're going to see a decrease in retained earnings for $26,000 because those are operating expenses. A decrease over here on the income statement, operating activities, decrease cash flow. Okay. All right, so that's what the horizontal financial statement analysis would look like. So like I said before, the things that are circled in red, those are the items that will change depending on if we're using LIFO, FIFO, or weighted average. So that's why I'm not going to go through this horizontal analysis every single time. And additionally, something that never changes is that this cost of goods sold over here that we see, cost of goods sold of 2,040 items, and then what's left on ending inventory on the balance sheet of 160 items, that's never going to change as well. So those items will remain the same. So theoretically, I should be able to go to the warehouse and count how many inventory, how many items, how many crystal apples are left in inventory, and there still should be 160. Okay. All right, the next one asks us to use LIFO. So that's last in, first out. So that's not really typical for a company to use LIFO. Companies that might use things such as rocks or piles, things with piles, because what's on top that gets scooped up first, those items are what would use LIFO. Most things use FIFO or first in, first out. I mean, it's just better for the flow of business to use those particular items in that way. Wouldn't you want to buy your food first in, first out? Or I'm sorry, wouldn't you want to buy your food last in, first out? That's the way we want to buy it, but companies try to set up first in, first out. So they put the oldest in the front. So you will go and purchase the older items first. Now, whenever I go to purchase my milk, I always go to the very back of the carton or back of the case to get the milk so I can get the older or get the newest milk, because they always put that older milk in front. So that is the inventory physical flow. But remember, companies do not have to actually match the physical flow of those inventory goods. They can cost for them in a completely different way. So I'm going to pause here and start a new video for the LIFO method.